All right, welcome to the director's cut. So we've got January 2022 production, and I don't think I have any housekeeping items. So I will pass it directly over to Lynn for all the latest.
All right, thanks, Katie. So talking about January 2022 production, and as predicted, we saw a pretty significant production drop because of the big freeze, I call it. I didn't know whether to call this month frozen or the bomb cyclone, because it has just been a whirlwind the last 2 or 3 weeks in terms of trying to keep up with what might or might not happen with oil prices and oil activity. But we'll look at some statistics first, and then we'll talk about some thoughts on activity. So in January, we saw oil production drop 5%, and that's a very significant drop, probably the biggest we've seen since the pandemic. It put us about 1% below revenue forecast, so that's a significant issue. Revenue forecast was calling for 1.1 million barrels a day, and we were at 1,087,000 plus or minus, so just slightly below revenue forecast. The price obviously more than made up for that. So oil prices today, the day started with WTI at 103, and it's off $7 or $8 from there. And so it's extremely volatile. But that price would put us more than 100% above revenue forecast. And in January, looking back to January, the actual realized price in North Dakota was $77.06. So it was 54% above the revenue forecast, way more than making up for the production decline. Very interesting that gas actually declined more than oil again, 7% decline in gas production. And that's really what drove the whole thing. One would think that North Dakota operators would always be prepared for winter, but that wasn't the case. Having 2 mild winters in a row, things weren't quite where everybody would want them to be. And so when the really cold weather came at Christmas time and held on through the whole month of January, we saw gas production, a lot of freeze-offs, a lot of problems with the gas gathering and processing infrastructure, and even power problems within that infrastructure. The result of that was oil companies, in sticking to their flaring targets and their ESG goals, shut wells in, reduced production, limited their production, didn't complete wells, and so actually oil production dropped, following the ability to produce and transport and gather and process gas, following that down. Permitting, pretty anemic in January and February. I just have to say, 32 permits in February and 39 in January. Those are not sustainable levels. Those are not production sustaining levels. Rig count, just the needle hasn't moved. And so we talked, I think we talked last month about the problems, workforce problems that industry is experiencing and the difficulty in adding rigs. I think prior to going to Houston in February, I expected the industry to add a dozen rigs this year. I've really dialed those expectations back, and I'm hopeful they can add a half a dozen. But that it is just a very, very difficult thing that's going on. Interestingly enough, New Mexico's rig count went up. They're at 98. So our prospects of returning to number 2 in production are slim to pretty far away. Wells waiting on completion dropped December to January. No surprise there. We have 11 frac crews running today, and for most of the winter we had 10 or so, 8 to 10. And so companies are aggressively pursuing the DUC wells, and so I'll just pause there and track a thought. Our largest DUC well operator, XTO, has doubled their frac crews from 1 to 2, but they plan to burn through their entire duct well count this year. So that is probably the biggest influence we've seen of the price increase. We haven't seen operators mobilize and really, try to figure out how to get drilling rigs in the field, but we have seen a lot of pressure on adding frac crews. And another operator that we've been working with that made an acquisition, had a substantial number of duct wells out in the Tier 3 area. They had a target price of $110, and so they're mobilizing and working on getting a second frac crew in order to work on those duct wells. They don't have a lot. They've only got between 1 and 2 dozen, but that really is the area that industry is emphasizing in this higher price environment. Inactive wells jumped. That is because wells were shut in. And interestingly enough, companies talked about that shutting wells in the middle of the winter in North Dakota is not a good idea. And that they have got to find a way to throttle wells back, because once you let a well go cold in North Dakota, it takes a workover rig to get it back on, and that is generally ends up waiting till spring. Wells completed, December was 65, January 75. So again, outpacing what the rigs can drill, or well, I guess December kept up with the rigs. January outpaced what the rigs can drill, and so they're chipping away at that duct well count, and that really is where the money's being spent. February looks like a strong month. Based on what's been reported to us, we think 90 wells were completed in February. So that jump to more than 10 frac crews really makes a significant difference. You can see the producing well count down substantially. That's wells shutting in order to avoid flaring and to maximize gas capture. You can also see that both the U.S. crude oil inventories and the world inventories are now way past tight. We're with the embargo of Russian oil by a number of countries. We're actually in a shortage situation, and so that's driving some pretty high prices. I will talk a little bit about gas capture. It dropped 1%. That's just industry trying to dial in. Actually, I guess it's kind of amazing with the kind of impact that we saw the weather have on gas gathering and processing, that they were able to dial in and stay above 91%. And so they only lost 1% in terms of gas capture. We're still focused on 3-4 fields, I guess, where we need things to happen in gas capture. And so our focus in our midstream meetings has been what can you do in Big Bend, Deepwater Creek Bay, Twin Buttes, and Charleston. We're not seeing a lot in terms of traditional gas gathering and processing, so we're shifting our focus to really work on flare mitigation in those areas. Bank of North Dakota held a webinar today on Bitcoin mining, and so it was interesting to hear the Bitcoin people talk about putting North Dakota flared gas to work, and North Dakota, relatively cheap electricity and cold climate to work mining Bitcoin. I found it interesting that they said that their projection is the 21 million or so Bitcoins that can be mined still, that won't run out until 2060. And that this particular company, I think, produces about 35 a day. That's pretty substantial at today's Bitcoin prices. So that was interesting, but we are very focused in this flaring area. And we have been directing everybody to those 4 wells to see what we can do for flare mitigation. So significant amount of activity in our federal court case to try to restart the leasing. And so you can read that for yourselves, but basically we have filed motions to reopen that case, to get back into Judge Trainor's courtroom, to get an administrative record in front of him before the end of the month, so that we can move forward with that and actually get some mandamus relief and get off the dime on all of these nominated tracks. So that's the story with January production and flaring. I want to talk a little bit about oil and gas in general and about the Russia impact, if you'll bear with me. So I have really struggled to figure out this 9,000 number, and I can't find it anywhere. The 9,000 permits or leases or whatever they are, but I just want to walk through what I've been able to pull down from the BLM's website in terms of North Dakota and U.S. activity. So first of all, by fiscal year, the number of new leases issued. North Dakota was experienced in fiscal year 2021. I'll just reference that. It was the 8th lowest number of new leases issued since 2001. So in 21 years, it was in the bottom third. And what we need to keep in mind is 6 of those were during the time period when the Corps of Engineers and the Forest Service were rewriting their resource management plans. So 6 out of those 8 years, we were waiting on the surface management agencies to rewrite their resource management plans. So really, there were only 2 years out of the last 21 that were better, or that actually saw lower numbers of leases issued than fiscal year 2021. When you look at the U.S. in total, it is the lowest on record. So the numbers I could find only go back to 2001, so they're only 21 years, but by far the lowest number of new leases issued on record. If you look back to 2020, which was, I guess, the last year of the Trump administration, that would have been the second lowest at 899. So Department of Interior has been really, really slow on issuing new leases. When we look at the total number of leases in effect, so we're talking the total number of leases that are out there either could be drilled on or actually have production on them. Nationwide, 2021 is the lowest on record, 21 years. North Dakota, it's the lowest since 2008. So the total number of leases is really, really low as well. When you look at the number of producing leases, North Dakota has been pretty steady since 2015, 2016. We're at about the same number. So we haven't added any federal producing leases since 2016. Nothing. We're at that same number. For the U.S. in total, it's the lowest number of producing leases since 2010. So way, way down. Some of that's the influence of the pandemic, and some of it is the influence of Department of Interior. And then when you look at the time to get an approved permit to drill, from 2019 to 2020, it went up 34%. And from 2020 to 2021, it went up 102%. So we're not just not leasing, but we're not permitting wells either on public lands. And you know, that's consistent with the strategy, I guess, or the attitude of the current administration. I counted 13 policy decisions that have been made over the last year and a half that were all negative to oil and gas, and none of those have been reversed in light of the current world shortage for crude oil. So the only positive signal out there is the price, and so it makes you a little curious. Why are oil and gas companies not really ramping up activity? And so I talked to a couple of our large operators. The first thing that they cited was that their investors want this to be cash flow and return on investment. They are not interested in seeing the profits from this higher oil price be plowed into new wells and new infrastructure in the face of an administration that long-term wants less oil and gas production. So they're thinking long-term, and they're saying, hey, we're just looking for a return on investment. We're not looking for reinvestment of this money in an industry that long-term has been designated as one that should there should be less of, not more of. And then the second thing that they cited was workforce issues. And Adam, you brought that up. And those have not abated. Industry is just really in a very difficult situation trying to find workers to ramp up production and activity. So Russia exports about 7.2 million barrels a day. 4.8 million of that goes to countries that are backing sanctions against Russia. So that'd be what, roughly 5 out of 7. 5/7 of that is company or countries that either have already implemented or are planning to implement sanctions. 2.3 million a day goes to countries that said, no, we're not going there. So 2/7 of it is to, for example, China, Belarus, India, countries that said, no, we're not going to sanction it. So I guess, 5/7 of it is subject to sanctions and 2/7 not. Who has the capacity to try to make up that 5 million a day? It's a great question. So it looks like Saudi Arabia and the United Arab Emirates could make up about 2.5 million, about half of it. And they have actually announced that they plan to increase production. So I think that was a big part of what we saw in yesterday's reduced price. Iran has the potential to add about 1.3 million to that. So that gets us to 3.8 out of 5. The US over a year to a year and a half could add about 750,000. And Venezuela, if private capital flows in there, because Venezuela's broke, so they of their own can't ramp up production, but if sanctions were taken off and private capital flowed in there over the next year and a half or so, they could increase production about 600,000, which would just offset the Russian sanctions. If you add all those together, that basically gets us to that point. Maybe not quite 5 million a day. So 2.5 plus 1.3 is 3.8, plus 3/4 of a million is 3.9, and another 600,000 gets us to 4 million out of 5 million. So the rest of the world really doesn't have the capacity to completely offset the 5 million a day. 4 out of 5, which is not bad, huh? If you're playing horseshoes or throwing darts, but if you're dealing with gasoline prices, it's not good. So that's kind of where things sit with Russia. The other thing I wanted to talk about was the European Union's dependence on Russian natural gas, and they get 40% of their natural gas from Russia. So until winter's over, there's not much chance of too many sanctions on Russian gas no longer flowing to the European Union, and there's a significant hesitancy to actually cut off the oil imports from Russia as well. But it is possible over the next, based on the analysis I've done, over the next 12 to 18 months, that 4 million of the 5 million barrels per day subject to sanctions can be replaced from other sources. That's going to take a lot of work. So, you know, it is a little troubling that our U.S. producers are finding it so difficult to ramp up production when you see $90 and $100 oil, but the financiers and the investors are saying no, that this is a short-term problem and we're thinking long-term. And long-term, this administration doesn't want your business, and also the workforce is not really there to push it much higher in the short term. So we'll take questions, Katie.
A lot to unpack there.
A lot to unpack, yeah.
I do just want to remind those who have joined online, because we've got a good number today, that there's a Q&A section within this Teams portal. So if you have any questions, you can open that Q&A and then you can type those there and I will ask those of the director. Otherwise, if there's any questions in the room, I'll open it to questions in the room.
I guess I should have mentioned one thing, you know, from the North Dakota aspect. If you're a North Dakota operator, these prices mean that your oil extraction tax is going to go from 5% to 6% in a couple of months. And that's a downer as well. So, you know, there are not a lot of positive indicators. There's more negative than or neutral than positive.
Question for you about your analysis that the United States over the course of the next year and a half could produce another 750,000 barrels, you said barrels a day, right?
Correct.
Can you talk about where in the United States that would be coming from, and you know, Permian versus Falcon, for example?
Yeah, great. So the question was that 750,000, where's that likely to come from? The vast majority of that is going to come from the Permian. We're already seeing pretty significant production increases there. I talked about New Mexico. They've got 98 rigs running. Texas has over 300. I forgot to look up the exact number. And so that's where the majority is going to come from. We think North Dakota could come up with 50,000 to 100,000. You know, that by the end of the year, there's a good chance that North Dakota could be at 1.2 million a day. So, you know, gaining back the drop that we saw from December to January, plus another 60, 70,000 barrels a day. But the vast majority of that's going to come out of the Permian. Nobody seems to be putting ANWR on the on the list, which of course I actually was in ANWR in 2004. I got invited to the island of Kaktovik. It's a little village off the coast of ANWR. It was May, and there wasn't a critter moving. It was all ice and snow in May. But of course, that the people of that village would love to see the activity there. And of course, the Alaska pipeline is running at about 25% of capacity. So that infrastructure already exists, but nobody has really talked about any realistic chance that that million to 1.5 million barrels a day will make it to market in the foreseeable future. So,
question about federal leases. There's been so much kind of controversy and discussion about them recently. Could you talk a little bit about to what extent can federal leases help respond to the problem now? You know, if we start seeing more leasing on federal lands in North Dakota, for instance, does that kind of provide an immediate fix for the solution, or is that more of a long-term benefit?
That's a great question, Adam. So the question was federal leases, and that's a really hot topic in this whole discussion. And if you narrow it down to North Dakota, what impact could it have? So we, over the last year, have seen a number of oil and gas cases put in front of us where wells could be drilled immediately if federal leases were made available. So that took us to evaluating, you know, what is the status of nominated leases in the state of North Dakota. there's over 800 nominated tracts in North Dakota. 242 of those could be leased right now. And if those were leased, we know of at least 100 wells that would be drilled this year on those leases. Total, they're blocking about 1,100 wells, just under 1,100 wells from being drilled. But some of those are incredibly productive areas, like under the Van Hook Arm, where there's 2 entire sections that are nominated. They've been cleared by the U.S. Army Corps of Engineers, and they're ready for leasing. So, yeah, that would provide a really significant immediate target for our oil and gas operators. And I think I don't know if Justin's going to get into that number, but interestingly enough, what we've seen is a real dichotomy between our private owned companies and the publicly owned companies in terms of adding drilling rigs back. So the privately owned companies actually have returned almost to pre-pandemic levels. I mean, they're basically at those levels. The publicly traded companies, not even close. And so it's the publicly traded companies that seem to be under this significant investor pressure. What's exciting about those 242 tracts is that the vast majority of them have been nominated by private companies, you know, the Petro Huntsons, Slossons of the world, which are prepared to go drill them this year. So I know I'm being a little pessimistic because I just don't see us getting those lease sales done, you know, under the current environment. But that would make a significant difference. You know, that could actually add easily 50,000, 100,000 barrels a day to North Dakota production if we could break that log jam. So that's a great question, because those tracts are ready to go, and they've actually been nominated by privately owned companies that are ready to drill them.
One quick follow-up, clarifying your answer to Amy's question. So you mentioned that we could get to 1.2 million, back up to 1.2 million by the end of the year. Is that kind of if everything goes right? Are you talking about if we start seeing some openings up of federal leasing, or is that given sort of current climate and completions of duct wells, that sort of thing?
I would, Adam, I'd answer that as probably the latter. So the question was, is that current climate and completing duct wells, or is that if we really could take the lid off this leasing thing and turn companies loose? And that would be under that first scenario, where they aggressively complete the duct wells, and then we see this inactive well count and the waiting on completion count drop very substantially. And it appears that it's turning out to be much easier for people to add completion crews, frac crews, than it is drilling crews. So that really is what we're counting on for 2022. Let's hope that turns around for the drilling rigs for 2023. We really need to see that number get back up into the 40s and you know, approach that 50 count.
Speaking of duct wells, can you just talk us through how long it takes to go through that completion process once you have a well that has been drilled and a company decides, okay, we want to make this well producing now? And then can you also just explain to us, as I think you probably have in the past, just what the completion process all entails? Sure.
So the question was about the amount of time it takes to do a duct well completion. And you know, it's a significant amount of planning that goes into it. With the new technology, they don't ever complete a single well. They're all simul-fracked, or sometimes they call it zipper fracking. But what they really want to do is frack 2 or more wells, generally 2 wells at a time, marching back along the wellbore, so that they get interference between those 2 wells, and they get the most for their money out of the frac job.
Are you talking about wells that are like on the same well pad?
Yeah, wells that are on the same pad, that are parallel to each other. That's what they like to do. And if if they can only get one frac crew. So they actually like to have 2 frac crews on the pad at the same time. That's the ideal world, which means, you know, with our 11 frac crews running today, there's an odd man out. But so somebody's doing a zipper frac, but what they really like to do is have 2 frac crews running at the same time and simultaneously fracking 2 parallel well bores. And so that takes about 2 weeks to complete, you know, 2 wells, simultaneously fracking them. One frac crew can do a zipper frac, but that takes about 3 weeks to do 2 wells. So a well a week is about what you can expect out of the frac companies, and that takes 2 frac crews to make that happen. So they're actually on the pad for 2 full weeks with 2 frac crews, and you get 2 new wells out of that process. So it's not really fast, but it's probably twice as fast as you can drill them. So that they can frac twice as fast as they can drill at this point.
Is there anything after the fracking process that needs to happen, like additional steps in the completion process, or is that basically it?
So yeah, the question was, what has to happen after the fracking process? And so there's a flowback period that runs about 2 weeks again, where there's a specialized crew that comes on that what they know how to do is flow frac fluid back, keep the sand from getting into the gas pipeline, and, you know, keep the sand going into the flat tanks, the oil going into the oil tanks, the water to the produced water tanks, and the gas into the gas pipeline without flaring. They have really changed their MO. Used to be they would flow these wells wide open for that first 2 weeks, and so you would see very rapid decline in these wells. Today, they produce them probably at 1/3 of their production potential, but they hold that 800 or 900 barrels a day constant for about a year. So used to be you'd see these wells come on at 2,500 barrels a day, day one, and by the end of that first year, they'd be down to 600 barrels a day. They're not doing that anymore. They're bringing them on at 800 or 900 barrels a day, and they're still producing 800 or 900 barrels a day at the end of the first year. So that technology has changed quite a bit, but you have to have a specialized crew come and flow those wells back, and then you can finally turn them over to the production people about a month after you start that whole completion process.
Just zooming out a little bit, I'm just wondering, first of all, when you were talking about the different numbers of which countries could add what over the next year and a half, is that all in the same timeline, or are Saudi and UAE equipped to increase production faster? And secondly, in the US, how much of the reason why it would take a year to a year and a half is because of things that were like dialed back over the last couple of years, and now it sort of takes some time to restart it, or how much of it is just other constraints that aren't related to past actions, if that makes sense?
All right, I'll try to unpack that. Yeah, so the question was, out of the countries that can add, you know, is there sort of a timeline of who can add that 4 million a day over the year and a half, and then how much of the US I guess bottleneck is because of things that have happened from the pandemic and following the pandemic. So we'll start with Saudi Arabia and the UAE. They have consistently been unable to meet their increased allocations. You know, OPEC has been for the last year saying, well, every month we're going to add 400,000 barrels a day. They have consistently not been able to meet that. So they're going to be on a little bit longer timeline than some of the other countries. Probably not as long as the US, which we're on like a 12 to 18 month timeline. Saudi Arabia is probably maybe half of that, but it's not anything quick or easy for them. They can maybe add 200,000 barrels a day this month, and then ramp that up, but there's significant infrastructure that has to be built and wells to be drilled to grow that Saudi UAE production. Iran's a different story. If all the sanctions were lifted, they pretty much already have that oil in the boats. So that 1 million barrels a day could come on very quickly. We're talking, within 1 or 2 quarters that would come on very rapidly. The US I've already talked about is a 12 to 18 month timeline. Venezuela would be much more on that 18-month timeline. That is heavy oil, takes a lot of artificial lift. A lot of infrastructure has to go in there. In fact, that they wouldn't be approaching those numbers until well into that 18 months. So it's a spectrum. Kind of to reiterate, Iran would be the soonest, 3 to 6 months. Saudi Arabia, UAE would be in that 6 months to 12-month time frame. US 12 to 18, and Venezuela's 18 plus. Talking about how much of the decreased production has been, has resulted from things that have happened revolving around the pandemic. I would say the number one reason that it would take so long to ramp up US production is going to be workforce. The supply chain is badly broken. The workforce isn't there. I just read an anecdote. I just talked with one of my fellow commissioners, a guy from Texas. They had a frac job. They actually had to shut down because they ran out of friction reducer. So they shut down a frac job in the middle. There are just so many supply chain issues. We talked about what Halliburton had to do in order to get sand in the Permian. I don't know if you remember that, but they had to invent an Uber for truck drivers to deliver sand boxes in the Permian. So that's probably the number one cause. The number two cause is just the fact that people are really unwilling to take the risk of massive investment at this point in an industry that is targeted to be out of business by 2050. And so the policies, the regulations and the policies of the federal administration are completely countercurrent to ramping up US production. And so number one, I'd say, is workforce and supply chain. Number two is the policies. I hope I unpacked the whole suitcase. Good.
Did you have a question?
Pretty much that was the answer.
Oh, okay.
We had a crystal ball. Where do you think oil prices are headed?
I beg pardon?
Where do you think oil prices are headed?
Oh, I personally think that we're in for a roller coaster ride and my crystal ball says between $95 and $125 a barrel on any given day. That the situation in Ukraine is so unpredictable, and the situation with Iran is so unpredictable that so I think that for the rest of this year we're going to be in a band, and on any given day it could be $95 or it could be $125. I don't see the underlying drivers that some people see to push oil to 200 or 200 plus. I just don't see that. I mean, there's always going to be those outside cases, but that, the basic data puts you in that band, which means gasoline prices ain't going down. Not much anyway. Again, your gasoline prices are going to vary between $3.50 and $4 a gallon here in the Midwest, and in that $5 to $6 range on the West Coast. So,
what does that mean for, hopefully this isn't redundant what you've already said, but in terms of producers or companies in the Bakken responding or trying to be sort of quick-footed responding to the prices right now? What is that like? I guess what you said was like a $30 range and volatility on a given day, how does that affect their behavior? Is that just kind of going to manifest in focusing on duck wells rather than rigs, or how do you, I guess, see the industry trying to be agile?
Yeah, great question. So how does the North Dakota industry respond to that large of price band and that kind of price volatility? Number one is that there is not going to be an idle workover rig anywhere in the state. So I've been looking at this because we want to get to work on orphan wells, and we are just so fortunate that through the CARES Act, we actually built a well plugging industry in the state. So there's a whole separate industry of several companies that's what they do. Otherwise, if you're trying to go find a rig to plug a well, forget it. Every workover rig is going to be employed returning wells to production or maintaining production on the wells. Secondly, every duck well that has any kind of economics or incremental reserves is going to get completed this year. I mean, that duck inventory is going to come down to just, how you're managing the wells you're drilling and flaring. So they're going to complete all of those. In terms of adding rigs, I think the desire is there, but it's low and it's slow. And so number one thing is the investors are going to do well because there's going to be a good, the cash flow is going to go to workover rigs, duck well completions, and return on investment. So the investors are going to do well. Longer term, I think it will drive increases in drilling, but not rapidly. The response is going to be in the workover rigs. If anybody who's willing to put on a pair of Carhartts is going to be able to find a job on a workover rig.
I'm going to ask one quick clarifying question, I think, and then we'll probably have to switch over to Justin. When you say duck wells, are we also referring to non-Bakken wells that perhaps have been temporarily abandoned, waiting for some of these prices to increase? Or is it primarily Bakken production that you're?
So when I talk duck wells, I'm talking Bakken wells. The other ones are in what we call the inactive well category. And those are largely, the reason we saw an increase in the inactive well category was because we had a lot of snow in northern and North Dakota this year. And many of those are stripper wells. They produce well under 10 barrels of oil a day, and it's not economic to even plow the snow. Now, at $95, it's economic to plow the snow and keep the well running. And so I think we're going to see that inactive well count. I'm hoping that by late spring, I'm breathing a big sigh of relief, and that inactive well count is down where we start to feel comfortable. But duck wells are Bakken wells. Inactive wells are legacy vertical wells or EOR wells.
Great. I think we'll shift over to
All right.
Justin.
Thanks.
You're braver than I was. If Amy asked me a crystal ball.
Just wait.
You don't have one?
That'd have been my first time ever using the no comment.
I thought you had a slide, a crystal ball slide. Maybe not. The EIA has.
Yeah.
Yeah,
I
you
can
use
point the
theirs.
finger there. So. You ready?
Yeah, go ahead.
Okay, perfect. Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. Just a quick summary roundup of oil production in the neighboring states. We don't have a good fresh number for eastern Montana, but over in that part of the basin, still at one active rig, 0 active rigs in South Dakota. I can tell you, after traveling through South Dakota this past weekend, a lot of wells active. So they're certainly pumping the wells that they do have in place down there at these prices. And so we'll see how those neighboring states continue to trend. And then in North Dakota, it's the only number we have for 2022 that Lynn just covered. On slide 4, when we look at kind of monthly changes, the one thing that sticks out to me on this is certainly on the gas side. This is when you take out the pandemic and what occurred there, this is the second most severe month-to-month change that we've seen in natural gas here in the state. And so the previous, or the record outside of COVID was that December 2016. And some of you may remember that time period. That was a difficult month. That was when DAPL was still wrapping up construction, really started at Thanksgiving, and we had one real tough month there in December and then trickling into January. So when we look at oil transportation dynamics in the basin, we're still seeing zero flows or movements north of the border, and we're continuing to see less volumes going out by rail in the month of January, and the pipeline segment taking more and more of that market share. When we look at slide 6 at how this breaks down, again, when you look at the economics and capacity availability for our oil transportation network, it's certainly favoring any type of spot movements to get onto those pipeline networks as opposed to the rail transport systems. On slide 7, just taking a peek at what was going on price-wise, and I'm going to translate this, and the reason I bumped this slide up was just to refresh folks on the pad locations, because I'm going to be talking about that here in a moment when we talk about Russia and potential impacts on movements for certain types of crude grades. So when we look at pad 1 and pad 5, again, those are our east and west coast areas of the US, and then pad 3 down in the Gulf. So in the month of December, pad 1-5, that's been consistent, highest priced markets. Again, those two marketplaces though are essentially completely reliant, especially pad 1, on waterborne or rail type volumes coming into those refineries. Pad 5 in that Pacific Northwest, they do have a bit of pipeline connectivity, but they're also heavily reliant on waterborne shipments as well as rail movement from the Bakken as well as Canada. When we look at least through January, we saw again a dip. So when we look at that production slide that we saw in the month, we saw those rail movements slide almost hand in hand. And so the rail certainly did take the brunt of that transport difference when we look at December to January. In December, the latest info we have on destinations, pad 5, that west coast, about 3/4 of all crude by rail leaving the state is continuing to move to that west coast, and 1/3 or roughly 1/4 there heading over to the east coast. And what you'll see on slide 10 here, I grabbed a couple screenshots from the EIA. And when we look at crude imports by country and destination, when we look, what we're looking at on this screen grab is crude oil specifically from Russia and where those inbound shipments are coming over the last 6 months and what type of volumes you're looking at. So you've got pad 1, East Coast, somewhere in that, we'll call it 50 to 75,000 barrel a day range. That West Coast, pad 5. You're anywhere from, averaging, we'll just call it 80 to 90,000 barrels per day. And then pad 3, that Gulf Coast as well, somewhere south of 100,000 barrels per day on average. Crude grades do matter in this as well. So kind of even deeper into the weeds, that pad 1 was typically importing a light sweet type barrel from those Russian sources. So when we look at, will we see different types of shipments and movements out of North Dakota as a result of what's been taking place? We could. We certainly, there's some opportunities maybe for some incremental rail movements to the East Coast. Those West Coast pad 5 volumes, again, that was a light to medium type grades that were coming in off the water. And I don't expect that Gulf Coast, that was typically a bit heavier, a little bit sour type grades that were coming in, some topped crude oil. So I would anticipate, though, if we do see some type of shift in movements, it will likely come on the rail side and then potentially to those East and West Coast refineries that were reliant on some of those waterborne Russian imports. It's tight. Things are very dynamic right now at the global scale. When you look at waterborne deliveries, what's available, what's not available. So this will continue to be fluid, no pun intended. And I'll do my best each month to keep everyone here up to date of how this is playing out. On the product side, the U.S. does import more products than crude oil from Russia. I don't anticipate any major impacts for the state of North Dakota as it relates to the products side, your gasolines, your NGLs, your diesel fuels, those type of things. I think that it will mostly impact our crude oil movements. When we look at slide 12, what we're seeing as of today, really strong pricing here for Bakken production. You look at Clearbrook, $5.69 premium to WTI in that marketplace. We've seen Canadian pricing be real strong coming into the Midwest. That does influence those Bakken barrels that are heading into those marketplaces. The Canadian barrels, particularly some of their mid to heavier grades, do fit real well into that slate to backfill some of those Russian volumes. And so there's been some considerable looks and pulls from that source. And then again, strong pricing down in the Gulf Coast for those DAPL deliveries. So with ample pipe capacity, good pricing in the Great Lakes as well as at the Gulf Coast, things look really positive for the Bakken production and the marketing capabilities. Not much to talk about on slide 13. Again, we're down at essentially real close to zero. The exports, those truck movements up into Canada, and then imports coming through the border ports have been relatively stable. Gas capture, Lynn alluded to it, and I think he did a good job kind of covering. I was a bit surprised as well of how strong the industry kept to meeting and exceeding that 91% capture goal. When you have these extreme cold periods with freeze-offs, you've got challenges with liquids dropping out in our gas gathering systems and the frequent pigging operations that I've talked about in the past of keeping those lines cleared to keep that gas flowing. It would be real easy for producers to, again, let some of that gas go to flare and then keep the oil flowing. But we, in the numbers, saw quite a bit of discipline on their front. When we look at slide 15, so again, this after 4 straight months of 6%, this was our one bump up on a 1 percentage point across the basin. Slide 16, still waiting for some updated numbers there, so I don't have any updated gas connections. Slide 17, this is all fresh, so not only the near term, but also the long-term outlook. And I did my best. It was here at the beginning of March, the EIA came out with their annual energy outlook, which has a decades-long oil price outlook, and then shortly, just a few days later, they released what they call their short-term energy outlook, and that's a 2 to 3 year outlook on prices. And I did my best to try and Frankenstein mix those two together and blend them as best I could, but there was certainly, given the current dynamics, a big disconnect, right? They are expecting here in the mid-2020s that there's going to be some certain downward pressure on prices, and we're back in that 60s, low 70s type range before a gradual increase going forward. When we look at the 2021 outlook to the 2022 outlook, there was a slight haircut on overall prices for crude oil, a several dollar discount or downgrade of what those outward decades look like for price, but still relatively strong and still healthy when we look at opportunities in the Bakken and drillable locations and what's attractive at $70, $80, $90 type markets. And when we translate, all this has now been wrapped into some of those production forecasts. This is in particular the gas side. So again, we're still looking strong for the next year or two on gas capture and processing capabilities, assuming things don't ramp up significantly stronger than we're forecasting. The industry does have a little bit of running room, which is again a bit outside the norm from what we've seen over the last 12 to 15 years here. Gas infrastructure, when we look at northern border, things have been fairly stagnant as far as volumes. Again, as winter has played out, we've seen production really flat, both for crude oil and natural gas. So we haven't seen, again, that big strong push that we're expecting, where more and more Bakken gas taking over space on the northern border pipeline. One other dynamic on slide 21, you'll see the BTU numbers at the lowest level in a number of years. If you follow natural gas liquids, so ethanes, propanes. The NGL markets follow much more closely to the crude oil price markets. And so when you see real strong oil prices, that means typically real strong NGL prices. And so it's not a surprise that folks have been leaning out the gas, trying to capture as much of that NGL mix as they can. And we're seeing that reflected then in some of these BTU numbers on our pipeline systems. So with that, I'd be glad to answer any questions.
Any questions there for Justin?
Gosh, Amy's looking at me and
You're gonna love this one.
Oh, it's Frankenstein.
I don't know if you have an answer for this, but if, in the coming months, we do see more Falcon oil get transported, I think you said particularly to the East Coast by rail. Do you have any sense how much we're talking about?
So when we look at what the easy thing to point to is what I showed earlier of what we know has been coming from Russia. So if you think about it as, we call it 50 to 60,000 barrels per day potential needs to be offset. If that area completely cuts off 100% Russian volumes, that's going to have to be made up one way or the other. And so whether Bakken backfills that, whether there's Jones Act ships coming up from the Gulf Coast, that's another possibility, whether there's other flexibility in the waterborne global markets, right, Nigerian or other crude sources. So we'll certainly see how that plays out, but the capability is there for those refineries to pull inbound rail volumes. They've got the unloading capabilities, and we've got the loading capabilities here in a similar crude slate. So that option is certainly out there.
Is it possible that oil from the Permian could be taken by rail up to the East Coast?
It is. So I don't know. I'm not as familiar with the Permian and what their loading capabilities are. So that would be the only question there, as well as the long haul, right? You have to look at the economics. Can that Permian barrel just get to the Gulf Coast and take that Gulf Coast price versus a Bakken barrel? Where is the best net back for that shipment, right? So
how do you come up with the numbers about how much gas has been captured? Like, are there some sort of sensors or monitors on the pipelines? And then what about flaring? Is that something that's self-reported by the companies, or does the state have a mechanism for measuring that or auditing it?
yep. So all the production numbers that you have seen, the gas production, oil production, flaring numbers, that all comes from the oil and gas division. So that is Lynn and Katie's division. So yeah, and then auditing department there. So they'd be probably better suited to answer that question. Yeah.
We can follow up with that one.
Do you have any data on how much Bakken oil gets refined, domestically here versus exported overseas? Does that data exist?
I don't know that it exists. I've not seen it. So the question for those online is there any data available of Bakken barrels that are heading to the Gulf Coast? Essentially, that's what you're referring to, right? If the Bakken barrels that are getting down to Nederland and other places, how much is refined here versus getting on a ship and being moved? I don't know if I've ever seen a public data source that answers that question. It's a good question. Yeah.
Volatility that's happening in the high prices, if that's shifting at all, where Bakken oil ends up ultimately overseas or here. I don't know if you can.
Yeah, it's a good question. I wish I had the answer, and I don't know that it exists publicly. Maybe there might be some proprietary data out there, but yeah.
To what extent would North Dakota gas and oil have fed into the Keystone pipeline if that hadn't been canceled last year?
So the Keystone, so the question was about the Keystone pipeline, and so more specifically, just because we do have, I don't know if I have a crude oil map in here, but just for clarity, so Keystone pipeline does travel through North Dakota there, but then the Keystone XL is the system that was canceled. So the Keystone XL, over the 10 plus years that project was in development, there were different plans and different proposals to have a loading facility near Baker, Montana, to take up to 100,000 barrels of oil per day. As that continued on, we saw less and less interest for North Dakota at the time because the producers couldn't continue waiting for that system. So they were committing barrels to Dakota Access or other types of rail movement. So that option was always there to batch Bakken barrels into Keystone XL. I don't know if it would have been a near-term solution, just given everything else that got built out over the years of delays. But yeah, it was always a possibility.
Then would it be accurate to say that the cancellation of that pipeline didn't materially affect North Dakota's ability to export new pipeline for oil and gas products if the producers had already shifted away to find other?
So there was, yeah, so the question was, did it directly impact North Dakota? It's tough on that when we look at the whole timeline of how, because there were projects moving forward to build access to Baker, Montana. And so there were projects that were planned to deliver oil to Keystone XL. As the delays continued, they scrapped or converted or repurposed those projects into something else. So there were certainly delays and things that held back those movements at the time. But over time, other systems have backfilled and replaced that need for that particular service, if that makes sense.
Okay, and just to clarify, did the Keystone XL have a planned route that crossed through North Dakota, or it just was right here?
It just missed North Dakota, and so it never traveled through the state. Yeah.
We are right at that 4 o'clock hour, so I'll maybe take just like one more question and.
I've got one. I don't know if you feel if there's something you can answer or not, but if we're seeing some at least marginal level of production increases in the next year in response to prices. I know you've said in the past that we are pretty good, at least for the short term, for like flaring goals. Does completing more wells or opening up some of the idle wells that Lynn was talking about, does that have any ramifications for flaring goals?
With how we've modeled, so good question. So, how does the next year play out as far as gas capture? I think we've got room for liquids growth at low single digits % throughout the year. If prices blew out and there was a big push and workforce showed up and all these different things, then you'd have conflicting, trying to ramp production up, but then also trying to stay within gas capture targets. Those would be two goals that would be real tough to meet at the same time, other than kind of that slow, low single digits oil growth, I think is possible to stay within those gas capture targets. But anything more aggressive than that would be a real challenge.
Yeah.
Yeah.
All right, well, thank you so much for joining today. One last plug, because a lot was covered today, is that we do post the recording of the Director's Cut on our website. If you go to the Information Center, you can find it on North Dakota Oil and Gas podcast or on YouTube, North Dakota Department of Mineral Resources. You can find the recording there, which should be up by 5 p.m. today. So just a reminder that if you need to go back and consume this information again, it will be there, which I may have to do that. Not at 5, but tomorrow. All right, thank you, everybody.